Good morning, everyone. Good morning to you, Lori. How are you?
Good morning, Lauren. Should we start singing Christmas songs soon?
I think we're in the season, so
You know, it might be a little scary because I have to say, when I sing, my cat puts her ears back and I literally go, "Boo, it's not that bad." And she just looks at me. So singing is not my forte. I won't do it, but we will like pretend little reindeers are dancing along the scene.
animals
Speaking
and
of,
kids tell you the truth, huh?
and I'm sure with kids, anybody who's in the middle of Christmas shopping right now is fully aware that we're starting to engage in the season. And I bring it up because I just want a reminder that next week is our last show for the year, but no worries. We're coming back on the 4th. We're just taking I think it's 2 weeks, if I'm not mistaken, a 2-week break. So everybody's got all of the holiday time. And I just want to mention that because I don't want anybody to click on the show in the next 3 weeks and go, "Oh my God, they're off the air." Nope, we're coming back. So with that, Lauren, I'll let you take over. I just wanted to make sure I made that announcement.
Okay, awesome. Thank you, Lori. Let me go ahead and share my screen and I'll have you confirm that
Yep,
you can see.
I can.
Okay, beautiful. All right, let's get started. Okay, good morning, everyone. My name is Lauren Simpson, and I'm with the SBDC, or the Small Business Development Center. We are a national program with over 1,000 locations across the country, and we offer no-cost services to local small businesses. Now, our services are at no cost to you because your tax dollars have already taken care of our fees. For the Los Angeles Network, we service the counties of Los Angeles, Santa Barbara, and Ventura. So if you are anywhere within the Los Angeles, Santa Barbara, or Ventura counties, please get in contact with one of our local offices. We have a map in front of you right now, and you can see where our centers are located. You'll want to get in contact with us because we offer no-cost business advising. And so you're able to sit one-on-one via Zoom with one of our business experts. And our business experts or business advisors have expertise spanning marketing, finance, business planning, licensing and permitting. If you're a handyman looking to go into construction, honestly, you name it, we've got an advisor for you. You might even be lucky enough to sit with our guru of all numbers, Ms. Lori Williams, as well. And we also offer virtual trainings. And so they are trainings that are comprehensive workshops, and they just help you to adapt and grow your business. Workshops like what you've joined today. So please, we're here to help you. Be sure to get in contact with us today. We'd love to help you get started. You can contact us at 866-588-7232 or go online, smallbizla.org/new client. Now, if you've reached us out, if you've joined today's show and you are outside of the Los Angeles, Santa Barbara, or Ventura counties, please go to americassbdc.org/find your SBDC. Let me go ahead and shut my screen share.
Lauren, before you go, what I'm going to do is I'll share my screen. This is giving you enough time. What I would like to do, if possible, can we pull up the website where you sign up for more information about the upcoming grants? I'll mention them in a second, but can I get you ready to pull up that website in a bit? Excellent. Yes. I'm going to go ahead and share my screen and I'll come back. So guys, hold on to that thought. I'm going to come back to it. So just a really quick, I don't have a lot going on here with it coming into the end of the year. So I'm just going to go to upcoming classes. I'm going to have my sales tax class on December 13th. This is being offered through the Pasadena SBDC, but you're welcome to take it from whatever area that you're at. And in the new year, starting in January, I will be picking up my financial literacy series, as well as a webinar that I held once. And it was so popular, I knew I needed to repeat it. And that's on legal structures and taxation, kind of an overview of what you need to know when choosing a legal structure. So once I get my schedule, I kind of didn't even want to look at next year yet, to be honest with you. I'm still trying to close out this year, but once I get my calendar. As always, I will be announcing all webinars on the show. Next week, I'm sorry I didn't change the date on this. I just realized this, but next week we got Elaine Rodriguez coming on, and this will be the last show for the year, as I said. Now, Elaine is a serial entrepreneur with 17 years of experience in small businesses, education, and tech. Quite a diverse background, engaged in a lot of different activities within the business community. But what I thought would be a really interesting dialogue and kind of leaving on a definite upbeat for the end of the year is we're going to talk about viewing entrepreneurship as a skill set for upward mobility, intrapreneurship and entrepreneurship, how to build a business with a purpose, and micro entrepreneurs are the future of business. I love that last bulleted point she gave to me to have a conversation about. So we're going to be ending with quite an upbeat year, as it's been an incredible year. So now, Lauren, if I could ask you to come back and share your screen, please. What I would like to make an announce is there's going to be, I don't have a lot of information. This is, you heard it first on Small Biz Talk. I always wanted to be able to say that, right? So I'm kind of jumping the gun, so to speak, on letting you guys know about it. So bear with me that I can't tell you a lot because I don't know. But next year, there's going to be what's called economic opportunity grants. I just know they're going to be very specific to certain types of businesses, so I don't want to give the impression that everybody listening may be able to apply, but I don't know. But this website that Lauren is showing you, and she's going to put in the chat as well, and sign up to get information. Please hear me, you're not up to apply for anything at this point. It's just a preliminary website for you to be able to sign up and get more information about them. And I'm supposed to know a little bit more, once we get into January and definitely by February. So I also get to say, tune in. We'll be telling you as soon as I get any insight on any of this, I'll be back to letting you know. Lauren, thank you so much for sharing that. I appreciate that. So with that, and you know what, Lauren, I got to ask, is Nate still with us?
I think he dropped off.
I do too. Can you, while I talk, I think he did. He's probably trying to get back on. So I'm going to do his introduction and tell a story. I was going to anyway. Can you work with Nate to get back on? I was just like, okay, our guest speaker is gone. I said to Lauren a minute ago, guys, I said, it's amazing that we haven't had any problems where I lost a guest and I had to do like some tap dancing or something. So I think I set it up. I may be teaching you tap dancing. But anyway, I was actually going to tell a little bit of story of what we were going to go over today. So hopefully I'll be saying it and Nate will be back to join us. He was there at the beginning, so I'm sure it's just a technology issue that he's having on his end. But Nate Jemison has been a guest on the show before, and he is engaged with the SBDC under what's called the Access to Capital team. He has a long time history in loan packaging, small business technical assistant advising services through the SBDC since 2008. He's an experienced business banker with over 20 years experience in commercial and corporate lending to corporate and middle market companies. And last time Nate was on the show, we talked a lot about the type of loans available, loan packaging, what you need to do, etc. I wanted to have, even though we're going to go over it if Nate shows up, if not, I'll be telling you my history on it. But if Nate shows up, we'll be going over a little bit of the background on documents. But what I wanted to do is I wanted to also have a discussion that I'm going to call a behind the scenes. And I'll tell you what I mean by that. Many of you know or have read my bio that I also was a banker. I never set out to be a banker. What happened is when I was finishing up my MBA several decades ago, I was also at the time engaged in a project with a company that had outside investors, and part of them was through the banks. And I felt as though I really didn't have a good understanding of the dialogue. And what I mean by that, the banks were coming in, they would sit down with me and the other executives at the company, and the banks were looking at numbers and they were saying things, but I was like, I really don't get it. And I was going for my MBA with a focus on finance. And I thought, here I am with an MBA, I'm focusing on finance, but I still felt like the banks were speaking a language I didn't understand. And also, and if you ever got engaged in those in the audience with banking or trying to get a loan or something, I had this like visceral feeling like whatever they were saying that I was not understanding was affecting me. So it was like I wanted to understand. So as the story goes, it's kind of an interesting story, is that I decided while I was finishing up my MBA, I've always, like I said, had my consulting company, but I was focused back in those days more on marketing. People know me as the finance guru. I was the marketing person then. And I said, I'm going to go ahead and I'm going to get a job as a banker for a period of time while I finish up my MBA so I can learn more about banking. And I remember at the time, a professor said to me, Lori, you can't get a job as a banker. And I was like, well, why not? Because I just, you guys have been around me for a long time. I get it in my head. I'm going to do something. I'm like, of course I can do this. Why can't I do this? There's bankers out there and I can do it, right? He said, you have no background as a banker. No one is going to hire you. No one will hire you, right? So Nate, come on and join us. I'm telling a background story to get us going. So Nate, welcome to the show. I'm going to get you here. I'm telling a background story that's going to get us going here.
Okay.
So this says to me, and I told you this story, Nate, so you're going to yeah, you're going to laugh, Nate. I never told you this story. In fact, I never told too many people this story. So this professor says, Lori, you cannot get a job as a banker, right? So first of all, I didn't know exactly what the words commercial lender even meant. I was like, okay, so let me call up a bank and say, okay, you're hiring for a commercial lender. What is it that a commercial lender does? Because I know I want to do this to learn, but I also know the professor said I can't. So let me find out what it is they do that I can't do. So this is the hilarious thing. And Nate, this goes back decades. I don't even know if you remember the bank, First Federal Bank of something. I can't even think. It was in Santa Monica. It went down during the recession in 2000. Yes. So I called First Fed, right? And I said, I wanted a commercial lender and I'd like to apply for the commercial lender job. What does a commercial lender do? Now, this is the shocking. Okay, you guys in the audience, I am not making this up. The guy on the phone says to me, do you own a company? Have you ever been a company owner? And I'm like, well, yeah, I've always had my own business, but I really want to know what a commercial lender is, right? He says, can you come in Monday for an interview? I'm like, okay. I thought to myself, I'm driving in Monday. I go, well, I'm in for an interview. I'll ask him what a commercial lender does, right? So I come in for an interview and he hires me immediately. Okay, what's going on? This is so friggin' hilarious. This is like how my life usually goes down. I think I said if I'm coming on planet Earth, it's going to be a big adventure this time around. So ready for this, Nate? Some marketing genius in the bank started a marketing campaign that said our company owner or our bankers are unique because they signed the front of the paycheck, front of the check. In other words, they're business owners. So they went out and they sought for 10 candidates that were business owners to start this special training to follow this big marketing campaign. And at the last minute, one of them fell out. So they were desperately seeking another person to join their team. So they didn't care that I didn't know anything about banking. They just wanted me to have owned a company to follow their marketing strategy. So guys, here I am in banking and I had this belief, and this is where we're going with this, Nate. So Nate, I had this belief about banking before I got into banking. I had no background in it. And I thought that everything was about you sit down with the entrepreneur and you really got to know their business. And if you liked their product, you supported them. And I didn't know it was about some numbers on a financial statement. And when I first went out on my first thing and I got from the client their financial statements, right? And I worked so hard to get the client to give me the financial statements. I run back to the bank and I hand them to the underwriting department. And I thought we're going to sit down and talk about it, what the company does and all this. They looked at three numbers and they said, no. And I'm like, no. And I even looked through, two numbers. So that's when I started learning about the percentage and the ratios that they looked at on financial statements to see if you even could qualify. So to the audience, it was a rude awakening to me on what actually happens in banking. And I understood then that what companies don't know about the way banking works, and this isn't like saying shoddy bad things, this is just understanding how the bank looks at you, what the bank does when they look at your numbers, what the bank is looking for. Once I knew that it was so different than what I believed as an entrepreneur, I realized how much of a gap there was between the company owner and their understanding and what happens in the bank. So we had Nate on last time to get into the specifics of bank loans and everything. And I told Nate, I said, Nate, I'm going to hit you with some very hard questions, and we're going to actually go into the nitty gritty. So thank you, everybody, for listening to my story. You can see where it's coming from. You can see where we're going to go. So glad you came back, Nate. I thought I was going to have to do tap dancing today, but we're actually some cool things. So let's officially welcome you, and let's get started with the first. We're going to go through some just simple things, and then we're going to build on it. Now, what I learned about SBA loans that I didn't realize as a non-banker is that an SBA, I always thought like there was this little building and it had a big SBA on, and you walked in this little building and the government had money there and the government was wanting to support you, so you borrowed from the government. I didn't understand how SBA loans are really constructed, and more so what I hear today from clients that they don't understand is they think, well, SBA doesn't have the kind of requirements that a bank has. Now, there's truth to it, but they expand it a lot further. So my statement to you is help the audience understand SBA loans. How are they a guarantee to the bank, and how they allow some companies to access funds that may not otherwise, but there's still requirements for documentation, collateral, etc. Give us a short speech on what exactly is an SBA loan from a government perspective and how it's structured.
Okay, well, let's start with the commercial bank first, because just like Lori had went through her experience of learning about what a commercial lender is, banks have policies with regard to making loans to businesses of all sizes. It can be from the mom and pop shop on the corner to a multi-million-dollar conglomerate like a airline. Banks make loans to those type of entities, but let's kind of stick to the smaller entrepreneur type of business. There are normally a traditional bank has set standards and policies. Like, for example, they ask you to bring those financial statements back, Lori. The first thing they probably look at is the bottom line on those tax returns. See how much income, if you're profitable or not, okay? That's their primary source of repayment. Then they might look at the balance sheet to see what type of assets you have. That's going to be their primary source of collateral support for a loan. Then they're going to look at maybe the personal financial statements of the owner to see what type of assets and how strong they might be relative to if they own real estate, blah, blah. If they have other income sources, not only outside of the business. So if those things are kind of satisfactory, they might move you to a credit consideration process to where they might consider doing the loan for you. However, if one of those parameters is somewhat weak, in other words, you don't make enough cash flow support, you don't show enough cash flow support, so they might want you to prepare a set of projections to repay a loan, they might consider you for a SBA guarantee. The SBA doesn't make the loan, but the SBA incentivizes the bank to make the loan by providing a federal guarantee to support the loan based normally on a percentage of the loan. Say you want $100,000, the bank determines that you are a good candidate for an SBA guarantee because you have some weakness in regards to your operations based on a review of the tax returns. So what they would do is they recommend you for an SBA guarantee. That doesn't mean that it's less documentation like Lori had mentioned. It might require even more documentation, even more work for you to do, like to prepare a 12-month financial projection, especially these days after we're coming out of COVID, because a lot of the businesses have suffered, some kind of deterioration in their revenues, maybe some deterioration to their cash flow. So a lot of people who normally would not require SBA guarantee might require a guarantee this time around because of the weaknesses in the struggles they've had from the pandemic. And normally the SBA will require a little more documentation, I have to say, but actually the SBA only provides a guarantee. So if you failed on that loan that the bank made to you and you have the SBA guarantee, the SBA will replenish or repay the bank by guaranteeing up to 80% of that loan. So like in a $100,000 loan with an 80% SBA guarantee, the bank would be entitled to recover 80% of that loan, which is $80,000. And maybe they'll eat the rest. If your business failed, if you weren't able to repay the loan, they would be willing to accept 20% of the risk of the bank would, and 80% will be guaranteed by Uncle Sam or the SBA. So the SBA acts as a credit enhancement for a bank to make a loan possible for an individual who might not otherwise qualify without the SBA guarantee.
Got it. Now, see, to those in the audience, here's some interesting things. Excuse me, I'm losing my voice this week. So when Nate was talking, you notice he talked all about numbers and how will the bank get the money back? And they're going to look at the personals to see if you can get, pay it back that way. They're going to look at collateral. He didn't get into, oh, they really love the product. They think it's a great idea. That part only starts after you first qualify on the number. So I just want to bring that to the surface because owners think that the most important part is what they're doing and to show they have a cool product that people want to buy, and it's really about numbers. And as Nate was saying, the guarantee from the government, even though it's not in the same fashion, I'm going to say it's similar to communicate. It's like when you have a guarantee sign on a loan for you, so the lender, whoever it is more apt to let you borrow because you got this other person, your dad, your mom, somebody that has money that's signing. And so that's how it opens up a opportunity to get a loan that maybe was not allowed at the first step with the commercial lender, but you still have to go through it. And even more paperwork is what I feel. And Nate, you said something that I thought was interesting, and I also want to discuss, because we see a lot of people that when they go to a bank loan, they have to get engaged in this process of numbers, and it's forecasting. And I also heard you say, and I know you've been talking about this for this year, the act of creating numbers to forecast is even more important, and the banks are asking it for, I guess if I could say, a little bit more aggressively, because they want to see where the company's going. So let's get our hands around forecasting so people understand that it's not just sitting down and going, I think I'll just take 20% and increase the numbers, that they have educated bankers looking at this forecast, and they can easily see when you put the numbers and you can stamp BS on it, when they don't make sense. So first of all, what is a forecast? What do you have to do to create one? And then let's make, after we stress everybody out about forecasts, let's talk about how the Access to Capital team helps clients to create these forecasts as well.
Okay. Well, the first thing you want to understand about forecasting is how to look at, if you're an existing business, especially where you've been. So you kind of want to focus maybe on the last 3 years and kind of track to see if your revenues have increased, are they flat? So any projection that you prepare or forecast that you prepare, the lender primarily is going to be looking for some growth. If you're at a point where you're stagnant, that's fine. But as long as you got cash flow and income coming in and to repay the loan, that's okay. But in most cases, most people borrow money to grow their business. So they're going to probably want you to prepare a forecast based on what it is, how much you anticipate you're going to grow your revenues, and what that's going to mean for the bottom line. Can you still support that loan? So looking at your growth, you kind of want to look first back where you've been to see what kind of growth you've experienced. Because that's really a good thing to have. If your business has been growing at 10% per year for the last 3 years, that's great. But yet, if you provide a projection that shows that your business revenue in the next year is going to grow at 40%, you've got to have the assumption. How is that happening? Why is that happening? You got to be able to explain that, okay? Because a lot of times people pull numbers out the sky. I want to make $1 million this year, so I'm going to just project $1 million. You got to have something to back it up. So most of the times, if you got some historical historical numbers that you can look at to show your growth can support what you're projecting for the future. Just be prepared if you're going to kind of like go up over and above that projected revenue growth that you're historically have on record. You have a reason. I'm adding a new service. I'm adding a new product. I'm expanding to a second location. That's why I'm going to have this kind of growth. Because what's going to happen is the bank has historical information and industry data that they can check your projections against. So if your projections don't really match up to how the industry has grown, there's a lot of resources out there that you can use too to track the industry data to show how that industry is growing. So a lot of lenders track that information that you provide them with as far as your growth relative to that industry data that they already have. And they'll say, oh, you're way above the industry, but they'll still consider you, but you have to have an explanation why your projected growth is going to be beyond like what the industry standard has been. So that's what we call assumptions. You have to get up your numbers.
Oh, that was just perfect, Nate. And you know what I always would say to people when I was working with their numbers and they would bring them to me, you walk away from your numbers and then you act as if your numbers are asking you this question: how did you get there? Did you get there because marketing? Did you get there because of that? You got to be able to explain. The story is so important. So a couple things. First, Lauren, if you could do two things for us, put in the chat your email, because we're getting a request from people who want to get a loan, want to know more from a loan. We want to get them to the Access to Capital team so they can get some appointments for one-on-one, because some of these are very specific questions. So Lauren, thank you so much. And then also in the chat, a reminder to everybody, when you do the forecast, they must be based on your historical numbers so they make sense, and you have to have a story behind how did you get there. Now, one of the questions that somebody had, and I think it's a great one while we're on SBA and we haven't quite left that yet, how long does this process take? Because people have to understand, I can't go in on Wednesday because I'm going to have no money to do payroll on Friday. Okay, Nate? So let's talk about the time period between the getting ready and meeting with a banker till you actually got money in the bank if you're lucky enough to get the loan. Let's talk about that.
Okay, this is where it's very critical for your listeners to understand that before you're going to get a loan, you want to be prepared. There's like standard documentation that you normally have to have. The Access to Capital team at the SBDCs can help you package your loan prior to even going into a bank to see if you're really ready. So, but from the time you submit a completed loan application to the time you get money in your pocket, you got to remember, we're talking kind of in general terms for a traditional bank. And if it's an SBA guaranteed loan, it could be probably a little longer. But see, some banks are authorized SBA lenders, so they can have a faster turnaround. But when I say a turnaround that offer any commercial loan application, you're probably talking 4 to 6 weeks. So if you've got a need like for tomorrow or something, or by the end of a week or two, it's probably not going to happen. And we don't want to really talk about alternative lending sources at this stage, because we're talking about traditional bank loans with SBA guarantees. Normally, you're going to probably look at a window of 4 to 6 weeks. If you're a non-SBA approved lender, it could be like 6 to 8 weeks, because it'll probably take the SBA to go through the whole loan package. They'll require another 2 weeks. I have to tell you too right now, because of the recovery from the pandemic, and the SBA still has like some issues with regard to like their personnel. So some things might take a little more time, but they have to do a lot of due diligence. You got to remember, especially with the SBA, those monies that they guarantee loans with are tax dollars. So they want to make sure all I's are dotted and the T's are crossed. So the process is a little bit longer. As far as the bank is concerned, there are some banks that might be able to turn around a commercial loan within 2 weeks. But again, there's more due diligence involved, because although it's not federal money, it's your money. When you go to a bank, the FDIC is your deposits and stuff. Those funds that they're using to loan you money. So there's normally a little more due diligence involved, checking with the state of California, making sure everything's clean, there's no liens. There's just a lot more involved. And that's what we call underwriting.
Yes.
As long as 2 weeks. So you got to be patient if you're going to go for a traditional bank loan. So I just want you to be aware. I'd say a 4 to 6 week plan would be probably ideal for you when you're thinking about getting bank loans.
Perfect, because a lot of people don't realize that. Now, while we're on SBA, and I'm going to go down into usage of funds in a minute, but before we do that, Nate, let's talk about 504s, because we have one in our audience, George. He's looking to get a 504 for a construction loan, but let's first educate the audience on what is a 504. And before I finish that sentence, George, do reach out to Lauren's email address so we can get you directly with someone in the ACT team to answer some of your specific questions. But let's go over a 504 and how, if the documents differ in preparing for a 504 loan. What is it? How do you apply? What's the process?
Well, normally a 504 loan relates to a large investment in a business asset, be it like heavy manufacturing equipment. So you might have a plant where you might need like $500,000 plus. But in most cases, SBA 504 loans are used for real estate acquisitions, real estate construction, real estate refinances. So the way it works is there are what we call nonprofit entities called certified development corporations. And they're the ones who kind of like manage the SBA 504 program. So say you are a customer of Bank of America, you went to them to buy a $1 million piece of property, but you might not meet those parameters. Remember, we talked earlier about, well, maybe you don't have enough cash flow support, maybe you don't have the down payment, because traditionally, Bank of America might require you to put 25% down to buy that property. That might be their policy, but you've only got 15%. So they might say, oh, you're a good candidate for the SBA 504 loan. So what happens is the SBA will step in and help finance a loan as opposed to guaranteeing a loan. A 504 loan is not a guarantee. It is where the SBA has a funding source and participates in helping you acquire that real estate. So if it's $1 million property, the SBA 504 loan only requires, under the 504 loan program, the investor or the buyer of the property has 10% down. That's all required to put down, 10%. Bank of America will only finance 50% of the total purchase. So they might give you $500,000 loan. The SBA is going to require you to put down 10% of the loan, and then they will fund 40%. So you got 40 kind of split for financing. So you can get 90% financing for that acquisition, that construction, and you only have to put in out of your pocket 10%. So that's how it works. So the bank loan will probably be at like a fixed rate, or it could be a variable rate. But the SBA portion, the 40% of their portion at $400,000 would be based on some variable rate, based on some cost index that the bank might use or something like that. But you get basically 90% financing to acquire a piece of property, and a lot of people are using that product. It's very, very popular. Yeah. And just so you know, the SBA portion is funded by a bond issue. That's how the SBA gets the money for that 40% to loan to you. But so sometimes it can take like maybe, and they only do the bond issues every 90 days. So it's another timing issue. You got to know where you're at relative to your escrow closing or whatever. But and the good part, as far as the bank is concerned, the bank will normally fund the 90%, the whole 90%, until the bond is issued and the funds are received. So they'll give you like the bridge financing maybe for up to 6 months for that $400,000 SBA portion until the SBA can fund that portion, pay the bank off. So the bank makes some nice little fees and stuff in the intro. So that's why it's so attractive. And at the end of the day, the bank is in first position with a 50% of $500,000 loan. The SBA takes a second position on the property with a second of $400,000. So in that scenario I just described to you, it's a very attractive product to where the buyer of the property only has to come up with 10% down, $100,000, as opposed to $250,000 if you went with a traditional bank loan, non-SBA 504.
Well, Nate, I just learned a lot about the 504. I haven't looked at that, in years since I've been a banker. I didn't realize all that. So I would say, especially another shout out, George, please connect with Lauren, because the SBA, the SBDC under Nate's team is doing special training right now on 504 loans to kind of get up to speed on everything to support clients in this endeavor. So please reach out to Lauren on that. So now that we talked about the 504 being for for real estate, et cetera. One of the things we didn't really say when we talked about the SBA loan, that it's titled the 7A and it's for working capital. And in this, Nate, what I want to do is I want to help the audience to understand that you can't just borrow money for everything, like going in and saying to the bank, I can't make payroll next week. Can I borrow money for payroll, right? So the bank has to look at what's called the usage of funds, even so as the difference between a credit line where you're borrowing money temporarily to borrow and pay for inventory that's sold, and a longer term, like term loan for equipment. So a lot of times people don't really understand that there is a requirement by a banker to say, what is the amount going to be used for, and when will the profits be received from there to repay it? And there's this whole relationship. So I know I just went along a whole long route, but Nate, I think it's important for the audience to have this understanding of what in the world usage of funds are and why it's important.
Okay. What you really want to understand, if somebody gave you $1 million or whatever, how would you spend it within the company? You know, a lot of times people want to go buy real estate and do other things, take money outside. But whenever you ask for a bank loan period, you should have a good idea of what the money is going to be used for. Like Lori had mentioned, like for payroll and things like that. If it's for payroll support, that's called a working capital need. If it's to pay utilities, working capital, there are a lot of different uses of money for working capital purposes. As far as the SBA is concerned, that covers a lot of things: inventory, payroll, utilities, just your general operating expenses. So understanding what your operating expenses are for you to continue to operate every day, every month. Normally, the SBA feels comfortable financing maybe 3 months to 6 months, depending upon where you are in the age of your business, the stage of your business. So if you've got like monthly operating expenses that include payroll and everything like that, for say like $30,000 a month, a $100,000 loan would probably be appropriate for 90 days, a loan for 90 days. A lot of times people come in and they want a line of credit. That's going to kind of be up to the lender, because remember, the bank is going to finance the loan. The SBA is providing a guarantee for it. Most SBA loans, they like to guarantee for maybe up to 7 years. That's kind of like under the 7A loan program, 7A loan program. Our guarantees for up to 7 years. So understanding your cash flow and what your need is very important, because, for example, if you're going to grow your business, you're going to add employees, or if you're going to grow your business because you need to have so much in inventory, that might be the perfect use of a term loan as opposed to a line of credit. The SBA does guarantee lines of credit that a bank might issue to you, but in a lot of cases, the bank will probably do a line of credit without an SBA guarantee, because normally the line of credit would be a short-term loan. So that would be maybe a 1-year commitment that they would be willing to make to you to pay for some of those operating expenses. So realizing that you have the income coming in more quickly, you'd be able to satisfy that 1-year commitment. Because when a bank gives you a 1-year line of credit, technically they're going to probably ask you to have the line as 0 for 30 consecutive days during a year.
Yep.
So you have to have the ability to pay it down like a credit card, pay it off every month. You charge something, you pay it off. That's the way banks really look at lines of credit, because otherwise it should be a term loan. And that's where the SBA 7A loan can come in. They can give you like $100,000, you pay it off over 7 years. And hopefully, you know, you'll have a good turn on your assets and be able to not need any more funding outside of that. So the SBA does provide some support for you relative to if you're going to grow a business, if you're going to expand a business, open up a second location, you want to do that under a term loan. The last thing you want to do is go into a bank and say, oh, I just need $100,000 line of credit. I don't know how I'm going to use it. I just want to have it, you know, any day. That's probably not going to happen, because you got to remember, banks want to make interest. They want to make money. So if they give you a line of credit and you hardly use it, they're saying that, hey, that's opportunity lost. We could have given that money to somebody else. So you got to understand that. You got to use it. But if you use it and you pay it down like within 30, 45 days, up and down, if it revolves on credit card, you can hardly be a good client for them. As your business grows, they might give you more money on your line of credit.
And one of the things that Nate said, and I want to point out to everybody, because a lot of times they don't realize this, in your documents for a line of credit, it may say, most often will, that you have to have a zero balance for 30 days at the end of it, which is typically a year. And I have seen people take lines of credit constantly, Nate. They didn't know that. They didn't have the money to pay it off. They term out the line of credit and you lose it, right? So that is something you really got to understand, that most line of credits do that. So now where we're going to go is I'm going to kind of introduce from a CFO, from my perspective as a CFO thought process. So when I was doing a lot of turnarounds where I would go into companies that were kind of having financial trouble and I was trying to figure out how to make them healthy again, I would look at all the different options for financing. Sometimes they were in a bad shape, so I couldn't get a bank loan. I'd see if I can get a credit line. I would see if I can maybe even get a lease if we need new equipment. I would just go through all the different financing vehicles available. Now, when I did that, Nate, I knew that sometimes I had to pay more interest than I wanted to because we just didn't have any other options, similar to when you start a company. You just don't have any options. You might even be using your credit card. But I had to have a consciousness that that interest was an expense and make sure I passed it on. Just this is the way it is, guys, to the customer or somehow. So I made sure the selling price minus our expenses has enough profit to pay for the money we're borrowing, because there's a cost of capital, right? So when you think about money personally, you know, the adage is, okay, I don't want to borrow money. I don't want to borrow money. But when we think about it from a corporate company perspective, we don't think about it with such strictness. We have a relationship and a respect that we just don't go borrowing money and rack up credit cards. But we do understand that the money, unlike I want to borrow to get this new car because it's really cool, we are borrowing money to put in the company to make money to pay back the loan and grow the company. So you have to have this real strong relationship between what the money's doing. So if you're borrowing money to pay for the fact that you couldn't pay your bills because you didn't have enough profit margins, that's not the proper way. You have to assess the financials in the business, right? So where I'm going with this, I wanted to put in my little CFO speak on why it's so important to have the numbers so you know, are you funding bad decisions and just debt you created because your cost structure is not aligned? Or are you putting money in the company that is actually helping you grow and will increase your profitability? So where I'm going with this, Nate, is I see a lot of companies kind of backed against the wall, if you will. I want to be respectful and state that, but they're taking advantage of some of these type of borrowings that, let's just say, the selling platforms are offering. Okay, I'll just say it in that. And Nate, one day, somebody, this is a while ago when I first started seeing a bunch of these, I had a client contact me and all she wanted was to know the accounting to put these loans into QuickBooks, right? And so I was going to give her the debits and credits, the accounting. So I said innocently, let me see the document so I know what interest rate they're charging so I can put it on the QuickBooks, right? She's like, no, all they do is they take a minimum of my sales and a percentage of sales. Okay, I can put that number, but what's the rate? What are you being charged? Nate, I was shocked to find out they didn't have this information. They weren't being told what the real interest rate. So I did a behind the scenes mathematical calculation based on what they've been taking. It was horrendous. It was much higher than they realized or I even believed. And I'm seeing more and more people innocently using these. Can you talk about that for a little bit, Nate?
Yeah. Unfortunately, when you need money, and you're not really disciplined and don't understand what it is you're borrowing, it can be very damaging to your firm or your company. We like to call those alternative lending sources, and they're mostly online. They'll promise you quick turnaround, 24 hours, 48 hours, we'll loan you money, but that money is based primarily on your bank account, your bank statements. They don't do any of the diligence like in a regular bank loan where you have to provide tax returns, et cetera. In most cases, now some have probably started doing that, but they ask for your bank statements a lot. Mm-hmm. They want to see what the volume is of activity. And based on that, they'll probably make a loan to you. They might say something like, oh, 15%, But the reality is you might end up paying like more like 60 or 70% at the end of the day, because
Yeah.
the way they get paid is based on your deposit activity. So they might debit your account, if not daily, because there are some, maybe once a week. So when you put money in your account, they're going to automatically take out so much. And normally they don't have the terms like Lori said all spelled out to you, because at the end of the day, you're going to find yourself not able to really grow your business as well, because you don't retain any money because they're taking money out every week. So even if you have an opportunity to grow, and I've seen this happen a lot, where people have a new contract or something like that, they want to fund that contract, but then they get another one. But because this money is getting stripped away from them every week, they can't really satisfy the growth or opportunities that they have. Then they come to the lender or the bank and want to borrow money and pay off those loans. And it gets really complicated because, like Lori said, there's no strict loan agreements. It's all done online, and it just creates a problem. But a lot of times the lender will step in and help you out in those cases if they see you've had those kind of loans. But they're there for a purpose. And see, there are rules against like charging excessive rates of interest, but not in the business climate, not in the business world. As a consumer persons, there are protections for you, but there are really no protections for business loans, because you're supposed to be a business person. So they think you're smarter than the average consumer. So you got to be aware of those kind of things. So there's no really limits that they can charge you. If you're willing to pay 80%, hey, albeit they gave you the money in a timely manner. All money is not good money, I tell people. So we at the SBDC, we always tell people, try to avoid those kind of loans. Really.
Yeah. Thank you for Yeah, thank you, Nate, because I'm seeing too many people, and you're right, they get stuck in this trap that they can't get out. They don't have the cash flow. They end up getting hurt and they can't get a loan. And that's why I want people to be more aware of it. So what, say that I'm a new business and I do need a small loan. Maybe I'm going to make up just a small number to communicate. Maybe I need a 10 or 20,000 to kind of get me started. And I really, SBA loan, that's not going to possibly work for me. I don't want to take out one of these real expensive loans. I know many companies use their credit cards, but there's also, and I might not be using the right term, Nate, so put the right term in if it's something different. There are some micro loans that are legitimate opportunities. They are higher interest rate than the banks, granted, but they're still a good choice. Can we talk about those options for people? And like I said, if micro loans not the right word, you insert the correct one.
Absolutely. No, microloans are very popular, actually. They can be, the terminology for them can take a lot of, they can have several different terminologies. A microloan is any loan like that's kind of below, I would say at some lenders, 50,000. Some banks offer microloans or mini loans or small business loans below 25,000. Like I know Edison used to have a program where they would give you up to 25,000 with 1 year tax return. As long as you have a vehicle to pledge, regardless of the vehicle, the quality, as long as it doesn't have a lien on it, they will give you $25,000 fairly quickly, like within 7 days. And you had a credit score of 680. And that was the microloan program. So there are loan programs out there, but the SBA has microloan programs too. And they're normally given to what I talked about earlier, those CDCs, those Certified Development Corporations. And it's supposed to be a quicker turnaround, maybe 2 years tax returns and things like that. And the CDC is the one who kind of approves the loan. But those loans could be as low as $5,000, very small, and a term for like up to 5 years in most cases. So I would recommend, if you're looking for like a small business loan of that size, try to avoid the credit cards if you can. Although that might be a good way, because a lot of banks will give you, you only need 25, they'll try to give you that credit card, you just let you go from there. But if you need a micro loan or term loan, which is more feasible in some cases for a startup business, where you don't have to worry about like paying the credit card down, up and down, just get a term loan for 5 years on a $25,000 loan. So I would probably, first of all, you want to probably check with the SBDC to see if they have some lending partners that could help you out in that regard. But there are like some churches that have those kind of microloans. They're available from a lot of different nonprofit entities.
They are. And that's the one thing during COVID, because I got involved with the IDLE and the PPP and unfortunately became the known expert on that. But I also got more aware of all of the micro loan opportunities that were out there that I would say, being a banker, obviously we weren't aware of because I wasn't in that world. I was more in the middle market world at the time, right? And so I really like to emphasize to people that there's more out there than aware of. And once again, guys, I really want to say, the Access to Capital team that Nate is in charge of, these are awesome advisors. I'm on the team as well, only from the number perspective, but this is a free service at the SBD. I always say not the number, but Nate knows I say that all the time because all the time I go, Nate, I'm done playing banker relationships. I'll be the behind the scenes. I'll support you on everything, but don't make me go out in front and be in that world again. So that's why he's laughing. So Nate, I have to, this next one is something that's kind of funny because I said it at the beginning and then I'm going to say something different. So I'm going to be like talking out of both sides of my mouth on this. Let me tell you what. So at the very beginning, guys, I said that the government's offering some grants and keep in touch with us. And you heard about it first here, right? Well, what I want to emphasize with people is what exactly was the usage of grants prior to COVID, what grants actually are, because I'm getting too many calls from people saying, I'm starting my company, where can I get a grant? And it's real confusing because I sound like I'm saying two different things. I'm saying, well, there could be some more little government grants, but that's not a way you start the company because grants typically have been an underwriting process for some kind of community development work, or you're going to figure out how to get algae out of water and, have more water for people or something like that. So let's get grants in their little perspective.
Okay. First of all, the first thing you want to understand about grants were really created to support nonprofit entities, right? A not-for-profit business. I have, say for example, you have a homeless shelter, okay? You're not trying to make money on it. You just want to house people. So there are sources for you to get money from. Federal government might issue a grant for that because they have concerns about homelessness, taking care of people. There are private institutions that might give grants. The Milken Foundation gave a lot of grants out when they were kind of around. So but normally there's a public benefit, your company is a public benefit company. So in a lot of cases, that's a private entity or a public institution that provides a service to the public. So you have all these resources for probably get grant money. Like the SBA IDLE grant thing that they had, that was kind of like a freebie to businesses, for-profit businesses, up to a certain amount, 10,000. The city, you can go to any city and ask what they have, what kind of grants they might have available to support your business. And if you find any city that's going to give you a grant beyond $3,000, because that would be an incentive for you to open your business in that city and start becoming a taxpayer. That's how they'll get the return. But they might give you a grant to beautify the space, make the leasehold improvements, the facade. It's not like to really help you hire people and pay salaries and all those kind of things. Now, some cities do offer employee assistance programs, which some people kind of like look upon as grants. And that's fine, but they'll subsidize the wages and stuff like that to incentivize you to move your company. But grants in general to start a business, if it's a for-profit business, it's probably not going to be available or are not really going to be available. But grants are basically, again, intended for nonprofit entities for that entity that's giving you the grant to get like some kind of publicity too. I can feel good about donating money to the Hearts Foundation, or the, what do you call it, Susan Coleman. That's the kind of entity that gets grants. It's kind of a public benefit thing. So a lot of people again went through the experience with COVID and got some grants that were created to help people get out of COVID, but those are going to be gone if they're not gone already.
Yeah.
So I just want you to be aware of that. Grants are not really a way to finance a business, to grow a business, a for-profit business. Okay, so just be aware of that.
Yeah, and I think even come next year, the grants that will be available are going to be very specific to certain types of industries that got hit hard with COVID. So it's not going to be across the board. And, with new companies, it is always a challenge. And one of the things I tell people is sometimes it's a matter of scaling back a bit on the projections. Maybe you pay a little bit more for less quantities of inventory so you can fund that, so you can grow your profits enough to start getting to a point where either you can qualify for a loan or you can start reinvesting in your company. So sometimes you just got to kind of wiggle up there a little bit and start working on it in a little bit more of a simpler business model. You know, I get too many people that want to jump into a business and they want to buy all this inventory, or they're going to go global. I'm making stuff up, but you get what I'm saying. Just trying to, bite too much at the first time. And that's never good anyway, because it doesn't allow you to get feedback from the marketplace. A miscellaneous topic that I'm just going to mention, and Nate, you may have a comment on it. It's a CFO type thing that I see a lot, is that keep in mind, guys in the audience, I'm not only have been in finance and a CFO for a long time, but I also actually just recently became an enrolled agent, which is like a CPA, but you're certified from the IRS rather than from the state. So I'm getting, I know a bit about tax returns, and always have, because I've looked at tax returns for so long, but now I'm even educated even more so on it. But this is what I want to just bring to mind. When your tax preparer might be doing something to help you and say, hey, if I do this, but you don't know what this is, it could reduce the amount of tax you paid. That thing that they're doing may actually harm you if you're trying to go out to get finance. And it also could be a red flag in some ways to the IRS, but I'm not trying to touch that aspect of it right now. But one of the creative things that CPAs and tax preparers, let's say tax preparers, sometimes do for clients are these loans from shareholders. And that is a way of being able to take money out of the company and not have it like money paid to the owner. But when banks see this, they immediately exclude it. And I've seen some tax returns over the years, and I've had to explain to the client, say, well, the banks aren't looking favorably. You've got loss on retained earnings. You've got a loan that's here that you really don't even have any loan documents. So I'm just going to make a little statement that says, when you are getting your tax returns done, be conscious and engaged with your tax preparer and understand what they have put on it from a conversation to see if they have done any things with retained earnings and loans, and be aware of it. That's my little kind of statement on it. Nate, do you have anything to add on that?
Well, you're right. When you have loans to shareholders on your balance sheets, most lenders, well, I would say about all lenders would consider that to be a intangible asset. So it automatically is deducted from whatever the equity is in your business, and that could create, in a lot of cases, a negative net worth. And when that happens, that means you're upside down, and a lender is not going to be probably too interested in helping you, unless you are have a personal guarantee where you got a lot of assets. In other words, strong enough to incentivize that bank to make the loan. But yes, you got to be really careful about the tax preparation. The bank is going to look at your bottom line to see what your net income is, because banks really rely on your tax returns to kind of really truly assess how strong the business's cash flow is. So there might be some add backs relative to some depreciation and things like that. Because also, Lori, just so you know, a lot of times some people will expense all the equipment that they acquire in a year, and they'll show it as like depreciation expense just to lower their income. So if you're going to be going in for a loan, you really want to show some positive income, at least enough to pay the debt obligation. So you got to be conscious of that. So that's the planning that you want to do ahead of time with your tax preparer. If you know you're going to be going in for a loan that following year, say we'll come to the end of 2022, if you're going to be going for a loan in 2023, you probably want to show more profits in your tax return. Unless sometimes people prepare two sets of books, one for the internal, which is their internal financial statements, and one tax guy. So you want to, if you're going to go to a bank, make sure you share both so the bank can kind of see the difference. This is what financial statements look like before the tax adjustments are made. And some banks might allow for some of those adjustments to be part of their lending decision. And
having a consciousness of it. Well, guys, Nate, we could talk on, and I got to have you back and back on the show. But I
No
hope
problem.
today what we've done is we've kind of approached this financing and banking and the relationships and the processes from a perspective of giving you more of behind the scenes background. I want to say again, please reach out through Lauren's email, get in touch with Nate and his ACT team, his Access to Capital team, because they'll help you with the projections. They'll introduce you to banks. They will really support you through this process. And one of the things they're doing is they're making sure your financials are proper and clean before the banker sees them, which is a really good step, because if the bank sees things and they look scary and they're out of order, they then suddenly go, okay, maybe I don't trust this person's numbers. So having that ability to use that team. So Nate, I just want to thank you. We had a really good conversation. I hope everybody in the audience learned something, got exposed to things. I'm getting a lot in the chat, really great information. Thank you. It's really good to have these conversations, Nate, because they're not commonly had in webinars and training, because it really takes people like yourself with so much experience. As you can see, everybody, Nate knows his stuff, to be able to have these conversations on what really happens. So thank you so much for being here. We so appreciate every time you come on. Just so lucky to have your information. So Lauren, I'm going to invite you back on. I think you're probably going to get a lot of emails from people, so we'll make sure we follow up and we get them to the right person to help.
Okay, thank you. You guys.
Thank you.
Okay.
Bye-bye.
Bye, Nate. Thank you.
Bye.
Well,
All
Lauren,
right, Lori, another great show.
I know that was a lot of information that most people never hear, and I'm so glad that Nate was here to walk through it, because to complete my story, that's some of the stuff that I learned after being a banker, and I had no idea. And as the story goes, so then what I ended up doing is I started a on-site seminar. We're talking decades ago, Lauren, but it was called How to Read Financial Statements, because I wanted everybody to have the inside information. Well, I have to say, as reality is so funny, my seminars were a huge success, but the reason they were successful, and I had so many people, is the banks got in tune that I was offering this, and they sent all their employees to my class before they got started.
Oh, that's amazing.
So I still wasn't preaching to these small businesses like I wanted to. And thanks to the SBDC today, I am. I'm into giving that you guys the inside information behind the scenes. So financing a company is always a challenge. I don't want to make it sound like it's impossible, but you really have to have a consciousness of what is out there. And most importantly is you got to do your internal numbers, so you're just not setting yourself up for a payment you can't make. That never ends up positive. So with that, Lauren, I just want to say thank you to our frequent flyers and everybody. I saw at one point we had 61 on the show. I cannot believe it. I just want to say a thank you to everybody that's out there every week listening to Small Biz Talk, and those who are watching it on YouTube. I sure do appreciate you. And Lauren, thank you for always being there. I know you're going to stay on a little bit to make sure everybody can get in touch with you, etc. I'm going to say goodbye and thank you to everybody for being here for another Small Biz Talk. Bye.
Thank you, Lori. Bye. All right, George, you are asking for a phone number. I'm going to do you one better. I'm going to give you an email address. Let me see. Please shoot me an email and I'll be sure to get you in contact, with Lori so she can get you some help. Anyone interested in meeting with the ACT team, please send me an email. It's that lsimpson@lbcc.edu. Aside from that, thank you for joining us today. We will see you next week, Wednesday at 10 a.m. for another episode of Small Biz Talk. Thank you. Take care. Bye.